Hey TMFG community, Carlo Cansino here with John Iaconetti, and in today's Ask TMFG episode, we'll be discussing everything about RESPs. So if you do like our content, please subscribe to our YouTube channel, give us a thumbs up or a like, or provide us with a comment. In today's episode, John will be discussing how to use RESPs in the most tax-efficient manner. We do withdrawals to help pay for tuitions, but is there an impact to your tax return? John, please enlighten us.
Perfect. Thank you, Carlo. So like you mentioned, today's focus is going to be on the withdrawals from an RESP. We have discussed RESPs in prior videos. If you haven't watched them yet, highly recommend that you do. Past videos, our primary focus was contributing to an RESP, building them up, what government grants are attributed to contributions, what tax deferred growth is in an RESP. But now we're focused on the other side of that equation. And if your kids are heading to school, you probably want to listen closely. So let's assume you're in that scenario. Your kids are about to head to university, probably have about $100,000 or so in that RESP. Well, what's in that account is broken up into different sections. So you have your contributions that you've made to an RESP. And then as well, you have the growth and the grants provided from the government. And that grant amount, a lifetime limit of $7,200, likely in that account. Now, each of these different sections are taxed a little bit differently. So first, your contributions, entirely tax-free. You're able to withdraw those amounts. Nothing there gets reported as income. Those are your contributions that you have made to the account. Second is that grant, that growth, portion of the account, and that is fully taxable upon withdrawal. Now, that's also referred to as EAP, or Education Assistance Payment. Now, there is tax strategies that we can use to minimize the amount of taxes that will be paid there. And really the main strategy in regards to an RESP is trying to get that EAP amount out as sooner rather than later. So when a withdrawal is made, often misconception is the thought that the subscriber or the parent will be the one who attributes the income. It's actually the other way around. So the beneficiary or your child would be the one reporting the income from the RESP. And that's actually pretty beneficial. So most students, imagine 17, 18 years old, if they are working, aren't earning too much of an income to begin with. Therefore, they're at a fairly low tax bracket. Or potentially they're not working at all and not earning any income. So this withdrawal actually may end up being entirely tax-free to that second generation or to that beneficiary. So there's a couple credits there that will benefit the student when the money is withdrawn. So we'll start first with the basic personal amount. So the basic personal amount is what every Canadian gets when they file their tax returns, essentially making a certain level of federal income entirely tax-free. So for 2022, the basic personal amount is $14,398. This means that a student can have any sort of taxable income below that level and not have to pay any sort of federal tax. Now, obviously, if they are working part-time, let's say earning $5,000 per year of income, they can earn, call it $9,000 or so of that EAP from the RESP and still not have to pay any tax. So anything up until that $14,000 number. But there's also another tuition credit that a lot of students get the opportunity to take advantage of, and that is the tuition tax credit offered from the federal government. So on average, federal tuition could be somewhere between $6,700 or so based on the data from Canadian universities in 2022. So add that $6,700 credit plus the basic personal amount, and that now increases our tax-free level of federal income to about $20,000 that a child can incur without having to pay any sort of federal income tax. So very forgiving amounts that are able to be taken on for the child, and that is part of the tax planning strategy. We want to get as much of that EAP out as we can in earlier years, as opposed to letting it sit in that account into future years. So on the other end of that spectrum, if we aren't able to get EAP out of that account, it actually turns into something called AIP, so accumulated income payments. Now, accumulated income payments are exactly like I said, that EAP of funds still left behind in the RESP. So some students may not end up going to school. Some students, you know, opt to or will not be able to utilize everything that's in the RESP. This is why we want to have the contributions left over if that is the case and not have any EAP remaining. So once that situation does occur and you have money left over in the RESP, you have a couple options. One of them is to transfer that amount into an RSP for the subscriber or have that money withdrawn. And now the problem with AIPs are having a certain amount of taxable income still in the RSP is that after the fact, they actually could be subject to potentially very high taxation. So AIPs will be subject to tax at the subscriber's marginal tax rate. But to compensate for the fact that there's been tax-free growth growing in that account for the past, potentially up to 30 years or so, the government as well charges an additional tax of 20% on top of that amount. So if you're at the highest income tax rate and you are withdrawing an AIP, typically you'd be paying 53%. You'd have to add another 20% tax on top of that. So it's essentially like you're being taxed at 73% on any sort of AIP coming out of the account. Now, I'd say this is fairly rare, especially for people that work in our office, because like I said before, our main priority is getting that EAP out as fast and in a timely manner as possible. But that's something that we want to plan against, or something we want to avoid. That extra 20% tax that the government puts if it converts to AIP or accumulated income payments. So that's our primary tax planning strategy around that. We haven't run into many 17 or 18-year-olds in a high marginal tax bracket, so it has been working so far. Obviously, there will be a unique situation, but that's part of the reason why when we're taking out your RESP funds, we're going to prioritize taking out the EAP or the education assistance payment to your child in a tax-efficient manner.
Thanks, John. I think this is a great time to be discussing these sort of minute details about RESPs. The current school year is ending and we're going to be heading into a new school year in the next 3 months. High school graduates now and their parents need to be thinking about how they're going to utilize their RESP to pay for their first year of tuition in university or other post-secondary educational institutions. So thanks a lot for that, John. Again, if you do, that's our episode for today. If you do like our content, please subscribe to our YouTube channel. Provide us a comment, let us know what you think about the video, or give us an idea of future videos, or just give us a like if you like what we're doing. Until next time, I'm Carlo Cansino.
I'm John Iaconetti.
And this has been Ask TMFG.